Well, I'm going to the city and I'm gonna do a steady show. And I know all my fans wanna learn how to make some dough. I've been cruising up and down for trades each and every night. And with my iPhone reclining, I know we're gonna get it just right. I'll get inside your mind, we'll have a real good time. We're gonna trade today, we gotta trade today. Go askSlim.
Hi, I'm Steve Miller. Call me Slim. And this is the askSlim Market Week. It's a look back at what happened in the financial markets in the past week, and a look forward to what might happen in the next week. And hopefully, lots of great ideas and opportunities for you throughout the show. Well, the stock market moved steadily lower this week as the S&P 500 moved down from a key resistance level. We've been talking about that level, and after a 10-week rally of some 20% to the upside, investors saw reason to, well, at least lighten up on their risk. It is comical as some analysts have been out there declaring that a 2-month bear market was over and then a new bull market had begun. We pointed out last week that the rally had become a standoff and buyers and sellers were kind of meeting each other, and now the sellers are winning out as focus moves to trade and world growth that is really slowing down. You know, it's not the same, and a lot of analysts out there treat this like it is exactly the same as all the other markets for all the decades back there, and these analysts are looking and using historic models, which make no sense as far as the valuations go, and the reality is probably going to be setting in pretty soon that 10 years of central bank massive printing and interest rates down at historically low levels for all this period of time, well, didn't do anything but push up asset prices, and world economies are struggling in a big way. Proof of that came out this week as Mario Draghi from the ECB came out and lowered his growth targets all the way through 2021, and in fact came out with a new QE program. They call it a little different there, but it's the same thing. They buy up the assets and try to put money into the system that way. The majority of the GDP of the U.S. world is showing a lot of problems in here. Besides the ECB, Japan is stagnant after some 3 decades of them doing QE and qualitative easing, buying up all their stocks. China now, huge bad numbers coming out as decline in their economy seems very apparent, and they have just put in a ton of stimulus to try to help that. And I'll give you their export numbers in a few minutes. They were just terrible. And of course, the U.S. is on pause right now, as they say. And I said some months ago that I thought the U.S. would not increase interest rates again this year, and I don't think that they will. I mean, things would have to turn around in a very big way, and believe me, they must have been talking to Draghi down the road, and they must have given some indication that they were slowing down. With all of this stuff going on in the world of incredible slowdowns, this is very meaningful. So here we are after all of this time, and the economies are slowing down, and these central banks are plain out impotent. It is ridiculous what they have done in here, and now they basically have nowhere to go. I mean, except maybe negative interest rates further down, buying up more things and adding to their balance sheet, and down the road causing bigger waves of deflation and inflation. This is not the way it should be. It should be organic growth that moves economies, but we're seeing nothing like that. And that's why the asset prices where they are right now are false. And we're going to see things change down the road. Let's talk about this technically a little bit as I share a chart with you. I mentioned last couple weeks that the markets had moved up to the 200-day moving average. I don't really follow the 200-day moving average. I use other ones. But a lot of analysts do look at it. And I want you to see this chart right over here, which shows you that the 200-day moving average had been support. You could see that in here as you look at this chart, and a lot of good sign for strength right over here that came in on that 200-day moving average. But then I want you to see the last few times through, it gave you these, well, we'll call them candlestick sell signals, inside down, evening star, and now it's doing it again right over here as the S&P 500 moves down below those levels again. So is this going to be another time a false breakout on the 200-day moving average, or is it just plain out meaningless? You could see in here the NASDAQ, basically the same thing, as it's doing the same type of failure at that 200-day moving average. And the Russell, even worse, it only got up through it by a slight amount. You could see it was working as support, and now it looks like it's working as resistance. And the Russell really having a much rougher time of it right now than the rest of the indexes. And that makes sense because as interest rates look like they were moving up, these lower price stocks, they got scared. But now interest rates are kind of range bound, and if anything, we've had a little bit of a breakdown in interest rates. So, you know, for months in here, we've been talking about the positive period for the stock market. In the first couple months of the year, we thought maybe it would rally up until early March. That's what it's done. And then we thought it would be a bad time for the stock market that takes it down through late May or June. And that hasn't changed. We actually think that's very, very much the patterns that we're looking at now. The market did get higher than we expected by about 4%, as we were looking for the S&P 500 to get up only to about 2730, and of course it did better than that, getting up to about 2816, and now we think it is really stalling. You know, the buyers still think that every opportunity is a buying opportunity. The bulls are always bulls, and I think that they have a hard time seeing reality often. And again, I'm talking about analysts out there that use their old models that make no sense in the environment that we're in today. We still see some chop in the market, and here we don't quite think that there's a top in place. It might elongate somewhat is what we're talking about, but the upside we think is basically over, and we think that the drunken binge that the bulls have had over these last 10 weeks, well, that's going to come to an end, and sometime between now and June, well, the bulls are going to be puking them out again. Let's take a look here as we look at our chart of the S&P 500, 60-minute chart, which shows you what went on this week with all of the news in there, and take a peek in here as we switch over. A little different because what we have in here is this red zone I put in here was that key area that we talked about for the S&P 500. And you can see what happened as it got up and tickled it on good news here on Monday morning that the Wall Street Journal had reported U.S. and China were in the final stages of a deal. But then look what happened here on Monday. News came out that Purdue Pharma was exploring bankruptcy based on a lot of lawsuits about some of their opioids, and that really started to weigh on opioid makers. And drug stocks and pharmaceuticals and healthcare, they're all in trouble based on the big socialist wave that's going on right now. And even if it's just moderate Democrats that get in, which is possible, we're going to see them really aiming at these stocks. And you had this big breakdown right over here. Overnight on Tuesday, China came out and cut growth, and they cut taxes and really raised lending through a lot of stimulus, and that only brought a minor decline in here. We got a lot of choppiness here on Tuesday. On Wednesday, the ADP came out up 103,000, and that was really a fake because of the payroll numbers being so bad here on Friday, but kind of mixed, and I'll tell you about that. Here, semiconductor sales came out down 7.2%, and that really weighed on the NASDAQ as the tech stocks really started to get hit. Thursday was this news that came out of the ECB. Their TLTRO, which is their QE essentially, they've extended their low rate policy and put in a new TLTRO policy program. So their economy is playing crap after 10 years of the same. I kind of had to put that note there to myself to remind myself of how much they stink. Draghi here lowers growth rate targets to 1.1 to 1.5%, and the market headed lower after that. Here's some a news article came out. New York Times said that China is uneasy about the trade talks, really. Well, their exports are absolutely plunging, so somebody better get online somewhere about how bad tariffs and trade wars are for the world economy. China's stocks fell overnight on Friday, 4%. Oil falls 3%, as all of this news about slowing economy is really starting to weigh on them. And then the payroll numbers came out. Estimates was about 180K to the plus side. It was only 20,000 jobs created, the worst in a few years. U3 at 3.8, the unemployment rate, but this is weird. U6 falls from 8.1 to 7.3%. That can't be. There must be some weather quirk or something like that. And housing starts had a huge jump, but that didn't matter as the market has moved down here all day long. As we approach midday, you can see as the S&P 500 is down about 25 points right now on Friday at midday. So that is what's going on today. And a weak market, as you can see, all week long, as you know, the market has not given all that much ground, a few percent from its highs in here, but that is maybe the start of something. The stock market for the week, the NASDAQ, Dow Jones, and the S&P 500 all down over 2.5% right now. They're also down nearly 5% as those stocks that suffer the fastest from slowing economy, from trouble, are the stocks in the Russell, because most of them lose money anyway. Bond market was up all week long, 30 years up about 2 points, and the 10-year yields just get crushed for 12 basis points, and that actually gets them down just below a very key level, which is going to make our patterns on the treasuries a little better than where we had them projected, and we'll be redoing those charts for our members coming up during this weekend. So dollar up about 0.8%, and Thursday was the big up day and day that brought that. Gold market up about $4, and that's after kind of suffering the week before and then holding for a few days on the downside, but then getting a pop here of about $12 on Friday on a good rebound. Oil market down about 50 cents on the week, as it was trying to get to the upside and failed several attempts, and then Friday it has this big move to the downside. That's it for what we bring you to start out the show, and coming up we're going to show you a lot of things about stocks, and of course our short-term view, which comes later in the show. So important to look at that. I've got 14 stocks to show you about in the best and worst stocks for the week. And of course, we look at what our projections are coming up for the next week. So we're going to get to that in just a moment. All right, I'm going to tell you quickly about our special we're running now. We have two great reports. The Stock Index Report, which gives you our comprehensive look at 3 of the stock indexes, and our ETF Report, which we break down the sectors of this S&P 500. You can get both of those reports right now for an incredible special. Try it out for the first month for just a total of $9.95. Let's take a quick look at the Stock Index Report right over here. I'll open up this week's for you to see, and what you can see as I scroll right over here is we have the S&P 500, the NASDAQ, and the Russell. I'll just take a look at the S&P. You will see our annotated charts in here, which gives you our cycle analysis. We're going to give you our technical summary on what we think is happening in the S&P 500. We're going to give you our outlook for the near term. That's the next 1 to 3 weeks that you can see right there, with some great information about the upside and downside that we expect. You will get our intermediate look right there, and you will also get our longer term look for the S&P 500. right over here. Just a ton of information when you look at that, and you'll barely ever be able to get that kind of a technical view. You'll also get our Spider ETF review, which is right there. Let me open that up for you quickly, and you'll see the stock sectors as we look at all of those right over here, energy all the way down, and we're going to look at the relative performance between them also. Let's just take a look at our charts here in the energy right there, and you can see that our weekly and daily cycle charts with projections, just like we do in the S&P 500. And then if you look here, you'll see all the relative comparisons in each of those groups as we look all the way from monthly, weekly, daily, and intraday, and you'll be able to get our a take on the momentum conditions and be able to make those comparisons. As you can see, you're going to learn so much by looking at this and getting all of this great information. Also, you will get our blog posts in here, which do great analysis, and our updates. All of this for just $9.95 for the first-time users. Become a member. All you have to do is write to Matt, M-A-T-T, at askSlim.com, and he's going to send you this special link for $9.95 for the first month. All of this information. Please do write to him right now. All right, make sure that you do write Matt at askSlim.com, $9.95 for all that information. You're going to learn so much. There's so much there that is going to give you a heightened market awareness. And you don't like it, just cancel. Spend $9.95 and you'll learn so much about what we do here. All right, so we're going to get to the charts as we look at the best for the week, the best stock for the week, Abercrombie, as this stock gets a very big jump. Let's take a look here as we move into the weekly charts in Abercrombie. 16% gain on the week in here as this stock just has this lovely gain, and it gets right up there to the area of the 78.6% fib. Generally, when a stock has a big decline like this, and you'll note that it had a double top and almost exactly came down to the measurement where we expected it to, when it recovers to the 78.6%, what it means is that the stock is a lot healthier, and that this dip that we expect in here down to maybe 22.5, 23 would be a very strong buying opportunity, and that's sometime in the next month. So we're going to look for that. Earnings beat, analyst upgrade the stock, and this is one of two stocks that we're going to show you here in the retail category. ANF in teen retail, not all of this group doing all that well, but this one definitely had a good move for the week, and we think it is a repaired stock that you'll be able to buy in a dip. You just watched the opening to the askSlim Market Week show. To watch the full show, just become an askSlim free member. It includes my analysis on the best and worst stocks for the week and my short-term view in 5 major markets for the coming week. You're going to learn a ton about charting, technical analysis, cycle analysis, my unique way of looking at charts, and we show lots of ideas that may bring some great setups for you going forward. Here's what's in that great offer that I think you're just going to get a ton of benefit from. You're going to get the full Market Week show. You're going to get Market Week archives, the special videos from our premium library, sneak peeks to great new products coming up, and all kinds of things along the way that we're going to put in there that you're going to enjoy. All you have to do is become an askSlim free member, and there is no credit card necessary. Please do join and take advantage of that and watch the rest of the show.
I'm going to the city and I'm gonna do a city show. And I know all my fans wanna learn how to make some dough. I've been cruising